This lesson is part 2 of our cash flow from assets discussion. We've already said in the previous video that cash flow from assets is cash that's distributed to creditors and stockholders because we don't need it for firm operations, capital expenditures, or working capital. We also said that it can sometimes be called free cash flow. And in the previous video, we calculated it as cash flow to creditors plus cash flow to stockholders. Now we're going to focus on the second equation. Cash flow from assets is operating cash flow minus net capital spending minus change in net working capital. So we've just rewritten that shorthand. CFFA, or cash flow from assets, is equal to OCF, operating cash flow, minus net capital spending, or NCS, minus change in net working capital, NWC. We're going to start by calculating operating cash flow and figuring out what are the components on financial statements that we need in order to calculate it. Operating cash flow is the cash flow that comes from our firm's general business operations. So what is our firm's main business? And how much cash flow are we generating from that? We calculate it as EBIT plus depreciation minus taxes, or earnings before interest and taxes plus depreciation minus taxes. All three of those components are on the firm's income statement. So if we look at a 2020 income statement and we're trying to calculate operating cash flow in 2020, we're going to go ahead and take EBIT, earnings before interest and taxes. We're going to add back depreciation, and then we're going to subtract taxes. So if we want to know why we calculate it this way, let's go through each line item on the income statement and discuss what type of cash flow it is, or whether it's even a cash flow. So if we look at sales, that's an operating figure, and with the exception of bad debt, we can assume that all of those dollars will turn into operating cash flow. Then we have cost of goods sold, which is also going to become an operating cash flow. Then we have depreciation. Depreciation is not a cash flow, so that's why we start the operating cash flow equation with EBIT, and we add depreciation back into it. Since we've subtracted it to get EBIT, we're going to add it back in because it's not a cash flow. The next line item is interest. Interest is actually a financing cash flow, so we can't include it when we're trying to calculate operating cash flow. The next line item is taxes, and taxes would be an operating cash flow. If we're operating and we're having earnings, then we're going to need to pay taxes. So this is why once we have EBIT and we add depreciation, we now subtract taxes in that operating cash flow equation. The next line item is dividends, and dividends is a financing cash flow. So again, we can't include it if we're trying to calculate operating cash flow. So this is why operating cash flow is EBIT plus depreciation minus taxes. It's really sales minus cost of goods sold minus taxes. Now we'll talk about how to calculate net capital spending. Net capital spending, or capital expenditures, is going to be cash that we spend on the firm's fixed assets. So this is going to be plant, property, and equipment. So the way that we calculate net capital spending is net fixed assets at the end of the year minus net fixed assets at the beginning of the year, plus depreciation. It's important that we add depreciation here, because if we don't, then we're not calculating net capital spending. Net fixed assets at the end of the year minus net fixed assets at the beginning of the year is just change in fixed assets, is not net capital spending. So if we're trying to calculate net capital spending for 2020, we're going to need the 2020 balance sheet for net fixed assets at the end of the year. We're going to need the 2019 balance sheet for net fixed assets at the beginning of the year, because net fixed assets on December 31st, 2019 is the same as net fixed assets on January 1st, 2020. And depreciation will come from the 2020 income statement. The reason we add depreciation back in here is because if we look at net fixed assets for 2020, or net fixed assets at the end of the year, remember that net fixed assets is gross fixed assets in 2020 minus accumulated depreciation from 2020 back. So this would be accumulated depreciation in 2020, depreciation in 2019, depreciation in 2018, depreciation in 2017, and so on. When we look at net fixed assets in 2019, or we can also say net fixed assets at the beginning of the year, that's going to be gross fixed assets in 2019 minus accumulated depreciation in 2019, minus depreciation in 2018, minus depreciation in 2017, and so on. Notice that that didn't include depreciation in 2020. So the net fixed assets amount in 2020 has an additional year of depreciation that the net fixed assets amount in 2019 didn't have. So in order to subtract apples from apples, we're going to have to add back in depreciation from 2020 to cancel out the fact that it's been subtracted in net fixed assets for 2020. So that's why we calculate net capital spending as net fixed assets at the end of the year minus net fixed assets at the beginning of the year, plus depreciation in that year. And that tells us how much we spent on plant, property, and equipment over the course of the year, in this case 2020. Another way to think of net capital spending is money we spent on big assets. Now we'll look at the third term, which is change in net working capital. When we're looking at the change in net working capital, what we're really looking at is how much did we invest in inventory and accounts receivable. So we can think of this change in net working capital as being cash we spent on smaller assets. Change in net working capital means net working capital at the end of the year minus net working capital at the beginning of the year. And we calculate net working capital as current assets minus current liabilities. So net working capital at the end of the year would be current assets at the end of the year minus current liabilities at the end of the year. And net working capital at the beginning of the year would be current assets at the beginning of the year minus current liabilities at the beginning of the year. So if we're trying to calculate change in net working capital for 2020, we would need the 2020 balance sheet for current assets in 2020 and current liabilities in 2020. We would need the balance sheet in 2019 for current assets at the beginning of the year and current liabilities at the beginning of the year. It's really important here to pay attention to order of operations, so it's a good idea to calculate net working capital, or the brackets, for each year separately and then subtract the net working capital amounts. So now that we know how to calculate all three components, we can calculate cash flow from assets as operating cash flow minus net capital spending minus change in net working capital. And it's a good idea to think of cash flow from assets in this equation as cash inflows, or operating cash flow, minus investments in big assets minus investments in little assets. Now, even though I'm telling you to think of it that way, you should recognize that operating cash flow doesn't have to be positive every year. Net capital spending could end up being positive if we end up selling more fixed assets than we end up purchasing. And change in net working capital can also be positive if we end up reducing our investment in net working capital. So it's possible that all of these can have the opposite signs. And that's the case for cash flow to creditors and cash flow to stockholders as well. Even though it looks positive in the equation, it's possible that cash flow to creditors could be negative, and it's also possible that cash flow to stockholders could be negative as well. Both of these equations are ways to let you know what's going on in the firm in terms of the cash flow, and we'll see this a little bit better when we work through a problem.